excited to share our project cryptocurrency price prediction using a stacked ensemble approach along with my teammates Adyaan Ahmad, Muhammad Wasif Shakeel, Muhammad Muntazar, Abdullah Hassan, and me, Hafiz Abdul Basit. Cryptocurrency markets are extremely volatile and unpredictable, making traditional financial forecasting models less effective. We set out to build a more accurate prediction model that works well in different conditions, whether prices are going up, down, or moving sideways. Our goal was to create a robust system that could help traders and investors make more informed decisions in this fast moving market.
Everyone, let's talk about our data. We collected hourly Bitcoin price data from August 2017 to May 2025 from the Binance API. This was all the data that Binance had in their database. This gave us about 68,000 data points that include opening price, closing price, highest and lowest prices, and the trading volume of that hour. We also gathered market sentiment data from financial news to understand how public opinion affects crypto prices. Data cleaning was also a crucial part of our project. We fixed time zone issues by converting everything to UTC, handled missing values, which made up about 2.7% of our dataset, removed extreme outliers that could throw off our models, created consistent naming across all data columns. For missing price data, we used time-weighted methods to fill the gaps, which is more accurate than simple averages. For missing news data, especially on weekends when financial bodies are closed but crypto markets remain open, we use surrounding values to remove the entries when necessary.
So for the exploratory data analysis, our analysis revealed several interesting patterns in cryptocurrency behavior. First, we found that open, close, high, and low prices are almost perfectly correlated, which isn't surprising but confirms they move together. Interestingly, trading volume showed almost no correlation with price movements, suggesting that high trading activity doesn't necessarily mean prices will rise or fall in a predictable way. Our sentiment analysis showed that most investor sentiment scores fell in the 80 to 100 range on our scale, indicating generally positive market sentiment despite Bitcoin's price swinging between $3,000 and $50,000 during our study period. We created several new features to help our models better understand crypto patterns, which were price changes and momentum indicators, moving averages over different time periods, measures of market volatility, analysis of news headlines using text processing methods. These features gave our models a more complete picture of what drives cryptocurrency prices.
For our prediction model, we used what's called a stacked ensemble approach. Think of this as combining the wisdom of multiple specialized experts rather than relying on just one opinion. We used three base models, each with different strengths. One, XGBoost, great at finding complex patterns and relationships between features. Two, Random Forest, excellent at handling outliers and capturing time-based patterns. Three, Ridge Regression, good at identifying linear relationships while avoiding overfitting. Each model was given a different subset of features to focus on. For example, XGBoost worked with technical indicators like price patterns, while Random Forest focused on past prices and sentiment metrics. These individual perceptions were then fed into a meta-learner that learned when to trust each base model's predictions. This is powerful because some models perform better in certain market conditions than others. To evaluate our models, we looked just beyond just accuracy. We measured how close the predictions were to actual prices, How well models predicted the direction of price movement, how consistent performance was across different market conditions, how the models would perform in a simulated trading scenario.
Now for results and insights, our stacked ensemble significantly outperformed all baseline models. It reduced prediction error by about 14% compared to the best single model. It correctly predicted price movement direction 68.4% of the time. Most importantly, it maintained consistent performance across different market conditions, whether prices were rising, falling, or moving sideways. The model was especially effective during high volatility periods, where it reduced error by 31.5% compared to baseline approaches. We found that different models contributed differently depending on market conditions. For example, random forest performed best during bull markets, while ridge regression was more accurate during bear markets. The model also showed impressive resilience to sudden market events, regaining accuracy within 72 hours after major market disruptions, while baseline models took over 2 weeks to recover.
In conclusion, our stacked ensemble approach provides significant advantages for cryptocurrency price prediction by adapting to changing market sentiments and conditions. Going forward, we would like to extend the model to predict prices further into the future, include order book data for more accurate short term predictions, develop better ways to analyze news sentiment, create confidence intervals for predictions to help with risk management. Thank you for your attention. We are happy to answer any questions.